Last week, we started the discussion on the macroeconomics. In macroeconomics, we see the economy through a telescope. What does that mean? When you see something through a telescope, you can see the big things. Like that, when you see the economy through a telescope, you can see big things: unemployment, national income, government budget, balance of payment, like that. Right? So then inflation. These are the things, macroeconomic concepts. Because this was one of the question in the March paper. You can go through that paper also. Right. These days I am marking the your answer scripts as the March paper, the answer script. Still I can't comment on that because very few the answer scripts have been corrected. They are okay, but still you have to wait to check the passing rate. Okay. On the macroeconomics, first we discuss the basic models, how to model the economy. Very primitive economy, no government, no import-export trade, only the whole economy you divide, household sector and the business sector. No government, this is a closed economy without government. So then you can understand why this model is important. You can understand the basic macroeconomic concepts, especially national income account. Where the household owns all the factors of production. They own land, labor, capital, entrepreneurship. Then when they receive income, what do? They consume. Part is consumed, balance is saved. How do they receive income? By providing the service of factors of production, service of land, service of labor, service of capital, service of entrepreneurship. Because they are the owners of the factors of production in this model. They provide services to whom? To the business sector, business entities. Yeah? And businesses taking this, considering getting these services of factors of production, they produce consumption goods for whom? To the households. Again, business sector produces investment goods. To whom? To the other firms. Investment goods. So the total output in the economy, therefore GDP, consists of C plus I. This monetary value of, market value of this GDP generates income to the household. All these income go to the households. With households are the owners of the factors of production. They get income. So GDP equals income. Supply equals demand. These are the two concepts. Next model, we introduce the government. Government, closed economy with government. Why it is called closed economy? No import-export trade. No X, no M. Again, now we have three sector model: households, government, businesses, firms. Government is a new entity. Government tax. Households supposed to pay tax to the government. Then government again demand goods and services from the firms. Government wants goods. Provide the government demand goods for the schools. Chairs, tables, computers, then the school buildings, highways, all these infrastructure facilities, they need goods and services. G. Government also now demand goods and services. Similar to the earlier model, GDP now consists of C plus I plus G. GDP. Monetary value of this. Generate income to the household. Household, what do? Consume, pay taxes. They can't say no to the government. Balance is saved. Savings is called residual. something is left over, something is left, something is residual, you save. You can't say first you save, then you consume, then you pay taxes. No. First you consume, then you pay taxes. If something left, then they save. Savings is the residual. Next model is a complete model, open economy. Now we have 4 sectors. Actually, 3 sectors can be seen. 4th sector is hidden. Households, government, firms. What is the 4th sector? Export, import, trade. X and M is there. That is the rest of the world. Rest of the world. Households, government, firms, and the rest of the world. So this economy, export goods, import goods and services. So the X and M. Now households, let's talk about household when they get income. By providing factors of production to the firms, what do? First consume. Consume domestically produced goods. Now we have M, imported goods and services. Think about how many goods and services we consume that are imported. Around 40%, 50%, 60%. Imported goods and services, shoes, saris, blouses, shirts, shirting materials, watches, everything from China, from India, most of the medicine coming from India, Bangladesh, all these things, right? So the COVID, AstraZeneca coming from India, right? So these are imported goods, household imported goods. Of course, government import, but we also demand imports. Imports, consumption, consume, pay taxes, imports, balance is saved. Now, firms produce consumption goods, investment goods, government also demand goods and services. They have to produce that also. Then firms produce exports, tea, rubber, coconut goods, and also services, computer services, housemaids, services of housemaids, then IT engineers, yeah, communication engineers, exports of services. Then we call that total output is called GNP. GNP consists of C plus, I plus, G plus X that generate income. Equilibrium GNP equals income, Y. Now this is the, actually I have given this, this is a complete model circulation of income. 4 sectors, now you can see households, government, firms, and the foreign sector. 4 sectors. Markets, labor market, financial market, goods market. Then the market forces, demand for labor, supply of labor. Demand for goods, supply of goods. Exports and imports. Right? All the interactions, transactions, monetary transactions are indicated. Taxes, the TH, household pay taxes to the government. Corporate taxes, firms pay taxes to the government, TC, TH, TC. Then there are transfers. What is transfers? One-sided payment. Pension is a transfer. One-sided payment. Government pay pension to the household. You don't expect any service back. You get this, household get this, pensioners get these payments. What? For the services they rendered long time ago. When the government pay the pensions, at that point they don't expect any service. That's why it is called one-sided payment. One-sided payment, not two-sided. Right. Then savings, SG, SH, household savings, government saves, the company saves, foreign save. All these savings come to the financial market. In the financial market, there are lots of other small markets, players, commercial banks, primary dealers, leasing companies, insurance companies. They are the players. Different market, insurance market, commercial banking market, primary dealer market, all the stock market also there. Large number of players are there. Right? But savings pooled. Financial market pool all these savings and invest in the goods market. Goods market. And that's all. That is the financial market, then labor market. Understand that. This is a good picture. You can understand the real economy. Other thing is, now in this economy, now today's lesson, we produce large number of goods and services. Domestic or produce goods and services. Sometimes you get inputs from the others. If you want to calculate the total output in the economy, producers by all the firms, all the players in the economy, calculate, but you have to deduct imports. Imports are coming from other countries, no? X minus F. So now this, now today's lesson is to explain this, the health of this economy. We said we use various accounts. National accounts, public finance is the government budget is another account. Balance of payment is another account. Transaction between government, domestic economy and the rest of the world. Import, export, trade and services. Monetary services, money supply. Demand for money, money supply, interest rate, repo rate, reverse repo rate, then the standard deposit rate, standard lending rate, everything discussed in this monetary sector. And these are the indicators of economic performance. These they have separate accounts. I mean, within this account, you have key indicators: growth rate, budget deficit, government revenue, current account deficit, balance of payment deficit or surplus, money supply. These are the indicators. These indicators are used to assess the economy. Assess the economy, right? Economy performance, direction of the progress. Right? These are indicators. Now these accounts are compiled by different institutions. Some are by the central bank, some are by the Department of Census and Statistics, some by the Treasury. For example, government budget is compiled by the public finance, the government treasury, MOF, Minister of Finance. Then the balance of payment and monetary service, the accounts are maintained by the Central Bank of Sri Lanka. Then the national accounts are compiled by the Bureau of Census. In Sri Lankan case, it is called Department of Census and Statistics. Indicators. Different accounts. Within that account, indicators are there. Now this define what is this different accounts, national accounts.
Excuse me, sir.
Yeah.
We did all this.
Yeah, this is a summary because I just want to come to this the summary of the national accounts. Yes, briefly we'll come to that point. Yeah, okay. I know. We discussed
okay,
that.
Thanks.
Then the compilers, you have to know the compilers, frequency, the flow and stock variables, whether the flow and stock variables. Then the each measure. Now this is the central bank annual report. You can see the central bank annual report. Had this. I think I should show this one. Right. This is the central bank annual report. The 2019 latest annual report. Now in this table, today's lesson, we have the appendix tables at the end of this chapter book. You have the appendix tables around how many appendix tables? 151 and the 151 appendix tables. Now here these national accounts tables 1 to 31, 1 to 31, table 1 to 31, 1 to 31. All the numbers, statistics relating to the national accounts, right? Chapter 2. This chapter 2 is the national income accounting statistic. I want you to read this chapter. Start reading chapter 2, national output, expenditure and income. National output, expenditure and income. Appendix table. Today we are going to discuss 1, 2, 3, some indicators relating to that. Right? Okay. Central Bank Annual Report 2019. It's important. Yeah. Right. Then we discuss national income accounting, the purpose of calculating national income. You want to calculate growth rate, per capita income, deflator. We'll come to this point where the definitions are important. At the end of this lesson, I'm going to calculate all these things using the 2019 or 16 annual report, right? Annual report. Why do we calculate? Then the graphical presentation of the discuss, graphical presentation, Sri Lanka's position in the context of the SAARC countries, in the context of Asian region, GDP, then the agriculture sector we discussed. Now these three methods of calculating national income. Three methods. You can calculate national income either production side, expenditure side, or the income side. I gave you one example. If you want to calculate the total value of economic activities within the households, you can either use expenditure, all the expenditure you add up, or income you add up, or the production, value of production, right? Okay. Then we discuss the value added, concept of value added. What is value added and why do we use value? Value added is, value added of this pen is the producer value minus material input. It helps us to avoid double counting error. Double counting error. Right. Now this actually I wanted to try this the example. That this was the last point. Remember, is that correct? We said the example, catering industry example. I think after that I didn't really. Yeah, right. Catering industry, the example. Catering industry, you have different economic activities. Wheat coming from farmers, wheat sell, the farmers sell wheat to the millers. Millers sell the flour to the bread producers. Then bread producers sell the bread to the sandwich makers. Economic activities. So each economic activity you can calculate the value added. Value of wheat grown by farmer, all the values are given. If you add up all these things, 625, that is wrong. You said the reason that is for the double counting or sometimes triple counting. When you calculate the value added, wheat growing value added is producer value 100, value of the product minus inputs. Inputs we assume 0, material input 0, but that is not realistic. Good example, but that's an assumption. Because when you grow wheat, you have the raw material, seed, wheat, then you have the other raw materials, but here we assume it is 0. 100 minus 0, it is 100. Then come to the milling part. Milling part, value of wheat sold by farmers is the 155. What is the main material input? Value of meat. Value of the milling, final value of milled wheat, 150. Main input is wheat, 150 minus 100, material inputs 50. Then what will happen? This value of the bread, using this wheat flour, bakers make the bread, value is 175. What is the key? The input is, main input is, material input is wheat, 150. 175 minus 150, 25. Now what we are doing is we are avoiding the double counting error. If you add all these together, double counting error. Then the sandwiches, value of sandwiches 200. Input is bread 175. Difference is 25. Now we can say total value addition of catering industry is 200. 200. Now that, and the interesting observation is that 200 is equal to the value of the final product 200. That is 200 sandwiches. So that's either you can say total value added 200 or value of the final product also 200. Now, but in the actual calculation, we can't calculate this final product. It's very difficult. Therefore, we go by this value added definition. Value added, value added. Value added of tea, value added of rubber, value added of coconut, value added of construction. Then you add up to get the GDP. Value of particular product is counted, right? Why the value added method is? To avoid double counting in the estimate of the total value of the production. Please go through that example. That's a good example as a past paper question, right? Now the concepts. Now still we are discussing the production approach. We have three approaches to calculate national income. Either we can use the production approach, or the expenditure approach, or the income approach. Now these concepts are related to the production approach. Gross domestic product, GDP, gross national product. So you have to know the difference between domestic and national. Again, gross national product and net national product. You have to know the difference between gross and net. Gross and net you can understand, because when you are doing a CIMA or the chartered accounting, chartered exams, gross and net, you always come across this. What is the gross? Gross minus gross value minus capital depreciation is the net. Net out. Gross minus depreciation is the net. That is the net value, NNP. So the total value added, total gross domestic product of the entire economy, value of goods and services produced in the economy. Then when you deduct capital depreciation, it is called gross, the net domestic product, or you can calculate net national product. Domestic versus national. Now first discuss what is the difference between domestic and national. What is GDP? Total value of production. Hello, hello, please. Hello, I can hear you. I can hear you. Please switch off your mic. Anyway, it's okay. The total value of production produced by the actors producing production residing within the country boundary, that is called GDP. Value of goods and services produced within the economic country boundary with the GDP. Right? It is the same. It is the value of goods and value means the monetary value. How many billions? How many trillions? Value of goods and services produced in an economy in a given period of time. Given period of time. Annually, maybe half yearly, maybe quarterly. When you calculate national income is a flow variable. You can calculate that annual stock, annual value, or the quarterly value, or the half yearly value. Time usually in an year or in a quarter. But in the department terms and strategic estimate national income annually, yearly, and also they prepare quarterly estimates as well. Now, GNP, GDP you calculate within the boundaries of the economy, value, goods and services. How many billions? Then what is GNP? GNP is you first you calculate GDP and make some adjustments. Adjustments to the GDP, then get GNP. GDP plus net primary income from rest of the world. Net primary income from rest of the world. I have given the reference appendix table 84 of the AR16. AR mean annual report 2016. You are the AR19, but more or less the same. Table 84, you can get this number. Table 84. If I check this, more or less the same actually, but the slightly sometimes they are different. Some adjustments are there. No, this time it is not there. Balance of payment, yeah. Net primary income, then this time it is 89. Table 89 of AR19. AR means annual report of the central bank. AR, this is AR. AR19, central bank annual report 19. Table 89. You can see it is one of the sub accounts of BOP, balance of payment account. It includes the net position, NPR. The table 84 of AR16. You can see this NPR now. Net primary income from rest of the world. Net primary income from rest of the world. It is from this one. 2019, the balance of payment table 89. Better we see this. Now you can see, this is the table. Table 89, balance of payment, net primary income. We have a separate lecture for this one. So net primary income. Net primary income, this is the one. 2019, 2426. 2426. Somebody has come. Anyway, here. Okay. Right. This is the table. Net primary income, net value is given here. The net value 2426 US dollars million, rupees 432 minus million 89, right? So that is the value coming from the table. It better to use the table so as well. Right. That is the when you go to the balance of payment account. Table 89 of annual report 19, then they have the annual balance of payment. You have separate account, goods account, primary income account. Primary income account net position is the NPIRW. GDP plus NPIRW is the GNP, gross national product. Right. Then the NNP, we have to calculate NNP. NNP is GNP minus capital depreciation during the production period. What is capital depreciation? It is a value of use of capital items such as machinery for the production. Example 10%. So the initial value, a car, January value and the December value. Not the same. Not the same. What is the difference? Difference is the depreciation. This table, January value, December value, not the same. Depreciation, right? The depreciation, right? The depreciation is like the cost of production. You have to deduct cost of production. That part when you calculate net national product. Different capital items have different depreciation rate. Computers, one rate. Fixed asset, the table, charts and tables, different rate. Buildings, different rate, right? These the standard the depreciation rates, how to calculate depreciation rates, percentages are given. The standard rates are there. Applying these standard rates to each capital goods, you calculate the total capital depreciation. Then NNP is GNP minus capital depreciation. Now let's go through again. First GDP, then GNP. Domestic versus national. Domestic is within the boundary. Value of goods and services produced within the boundary of the account. In that case, whether these companies within the boundary. Now we have Chinese, the port product is there. But the Colombo port project is there, owned by this, conducted by, invested by the Chinese companies. So the Shangri-La is there. Then the Hambantota port is there. Ownership different. But when you calculate GDP, we include those value added of those projects also, those sectors also. Adjustments coming from GNP, where the Chinese companies or Sri Lankan's bank operating in Bangladesh, Chennai or London, they remit their profits. Yeah. Chinese companies operating here send their profits abroad. Now these transactions are entered in this NPIRW, net position. That's why then when you get GNP, you have to add NPI, net position of that account, to GDP in calculating GNP. Then net and the net national product is different. GNP gross minus capital depreciation is the net. Right. Then how do actually calculate? How do we actually calculate this? Value added actual method. I will go to the table, because please get it annual report, one of the annual report either 18 or 19, because I have the latest one, the 2019 annual report, because by April they will release central bank release the annual report, but these estimates are coming from census and statistics department. So in this table, first two table 1 I will read first before showing that gross national income by industrial origin at current prices. Table 2, gross national income by industrial origin at constant 2010 prices, constant. We'll discuss the difference. So here you have key sectors: agriculture, forestry and fishing. Under agriculture, forestry and fishing, 16 subsectors. Second key sector, subsector is industries. Industry sector, you have under 17 subsectors. Then the services subsector, you have 15 subsectors. Service sector, 15 subsectors. Altogether, 48 subsectors. I'll show that. You can see, this is the table. Table 1, national output. You can see agriculture, forestry and fishing, industry, services. Under agriculture, you have 16 subsectors. 16 subsectors. Growing of the cereals, growing of rice, growing of vegetables, growing of fruits, like that going on. Freshwater, fishing and freshwater aquaculture. Industries. Industrial sector, you have mining and quarrying, manufacturing of food, manufacturing of textile, manufacturing of wood, manufacturing activities, then the manufacturing of furniture, other manufacturing and repairs, electricity, gas, stream, water collection, storage and waste, the construction. Under industry. Under industry, you have the 1733, I see it, 17 minus 33, yes, 16, 17, 16 subsectors, another, yes. Industry. Then the services. Services sector, you have 34 to 48 subsector, the around 18, 14 subsectors. What are these sectors? Wholesale and retail trade services. Transportation, postal, courier, accommodation, programming and broadcasting, telecommunication, IT programming, financial services, insurance, real estate, professional services, public administration, education. Now, what does that mean? These are the economic activities, key sector, whole the economy, we divide into 14 subsectors. 3 key sectors: agriculture, industry and services. Under each sector, you have subsectors. All the economy divided into 48 subsectors. That is for calculation purposes. From each sector, you calculate value added. Then total value added is called then you can calculate gross domestic product, GDP. GDP is calculated, sum of all the value added. From the GDP, you go to the balance of payment table, then you get GNP. Right? Please see, go through this, get the table, and calculation is huge. Now in the Department of Census and Statistics, there is a separate division, National Income Accounting Division. But in some countries, for example, Thailand, yeah, the whole there's whole department is there to calculate national income estimate. The Bank Negara, separate department to calculate national income because it's a huge economy. Then you have to collect data, annually collect data. You have to conduct surveys, small scale surveys, household basis, economy-wide surveys, small surveys. Based on this calculation, because the national income accounting, you cannot calculate 100%. Think about that, 100% accurately. I don't misunderstand my statement. 100% accurate. The huge, large number of economic activity. So therefore, that's why we do the surveys, small scale surveys, and extrapolate these last year numbers using those survey results, like that. Right? Or some sectors you collect data. Real sector, tea production, rubber production. What are the material inputs? Calculate value add. Construction activities, calculate value add, value, highways, school buildings, prisons, motorways, calculate what are the material inputs. You can calculate. But some sectors, you calculation done by using the surveys. That's important. Otherwise, annual you can't present because in Sri Lankan case, to present all the calculation, you have the December annual, the academic, the calendar year finishes December. So you start collecting data maybe from the last quarter. Then maximum you can go up to next year, April 31st, you have to calculate, publish this annual report. Publish this annual report. Therefore, very limited time. You collect data, calculate, go to the computer, worksheets, do the things, surveys, everything. So it's a huge exercise. Huge exercise. Right. 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 Now, altogether, we have 48 subsectors. Agriculture, forestry and fishing 16, industries 17, services 15. You can go to this, you can go to the Central Bank annual report and just go study what are the key sectors, what are the economic activities in the economy, right? Contribution. For example, if you take this, the contribution from the main sector, agriculture, industry, services, what do you think? Which sector of these three sectors, which sector contributes most to the national income, GDP? What do you think? That coming from agriculture, industries, or services? Main value addition, contribution coming from the agriculture, industries, or services? What do you think? Which sector contributes most to the GDP? Question. Which sector contributes most to the GDP? Industries, services, or agriculture? Hello? Tell me. Question. Services sector. That's very interesting. So the service sector contribution more than 60%. Agriculture around 12%. Balance is industries. Now, if you see the national income statistics in 1950s, 1960s, which sector contributes the most? Agriculture. Then industry, then services. Now you can see from 1950s to, if you plot the contribution, value-added contribution, agriculture contribution as a percentage of GDP, decrease. Percentage-wise decrease. Value-wise, billion, rupees billion might increase, right? But the percentage decreases. Services increases. Service sector contribution increases. Service sector those days, I'm not quite sure, maybe 10 to 15%. Now it's around more than 60%. Services, huge services activity. So this is economists say this is a stylized fact of the development of any economy. Contribution of agriculture, forestry and fishing coming down percentage wise. Service contribution is increasing. Singapore, US, Thailand. This is true for any economy. Right? Remember, don't think that rupee value is not decreasing. Percentage wise decreasing. Rupee value is increasing, right? Rupee value increasing, but percentage as a percentage of total GDP, service sector growth is huge in recent times. Right? Right. How do you value the? Now we know. Now generally we know the idea about the value addition. How to calculate value addition? Producer value minus material inputs. Now production value, quantity into price. Production value, quantity into price. For example, if you have, let's say, an economy, you have only economic activities, coconut cultivation, no agriculture, no agricultural activity, other agricultural activity, no industries, no services. How do the real economy? Think about only economic activity, coconut cultivation. Annually, you want to calculate. Let's assume coconut production is the 1,000 nuts. 1,000 nuts. Then price of a coconut is 100 rupees. 1,000 into 100. That is the production value. 1,000 into 100. 1,000 into 100, 10,000. Right? Value. But this value, there are two methods to calculate the value added. You can calculate this value of the production using the current prices. Current prices. Now these days, the coconut price, maybe retail price is around 120, 110, 100. Yesterday, the Apico, the price was 95 rupees per coconut, right? But the producer value may be different. Producer value may be, producer price may be around 80, 60 rupees, right? Margin is added, no? The retail price. So 80. That is the. So we can value this the output two methods using the current price, current producer value, current price, or using the price prevailing some base year price, current market prices or constant prices prevailing in some other price, other year. Why is that? When you calculate the GDP, when you calculate the production using the particular year, prices prevailing particular year, then what will happen? This year, let's say the 1,000 into 100. 1,000 into 100 is 1,000 into, yes, 10,000. No, 1,000 into 100 is 1,000 into 100, yes, the 10,000, right? 100,000. 100, yeah, 100,000, 100,000, 100,000. Then what will happen next year? Let's assume production decreases. Coconut production decreases to 500. What will have the price? Price increase to 150. Then price increases, production decreases. Price increases, production decreases. If you calculate the current price level, 150 price level, value may be increasing. Value increasing. 150 into 500. This time 1,000 into 100. 1,000 into 100. 1,000 is the production. 100 is the current price. Next year, production dropped. 500 into 150. Current prices, it has increased. Then one can say, oh, you see, GDP has increased. But it is not the case. In real terms, it has dropped. 100 to 150, 100 to 1,000 to 500. Understand? Production drop, but value terms increase. See the difference? If you calculate the production using the current prices, GDP at current prices increases. But that's not a good indicator. We have to make something, do something. Why is that? We know real production drop. Therefore, we use the other type of estimate, constant prices. What is constant prices? We use 100 every year, 100, 100, 100. Price 100 this year. This if you are got 100, this year value production value is calculated using price 100. Next year production value is producer value is calculated using 100, 100, 100 all the years. Then you can avoid these price increases. This producer value just shows the changes in the real output. Real output. Therefore, constant prices are more meaningful. Constant prices mean every year when you calculate producer value, same price is used. No price effect. Then the producer change in producer value indicate the change in quantities only. Current prices, you calculate prevailing current price 100, 150, 175, 200 like that. Current price is used. GDP current price estimate, maybe all the time it is increasing. But the constant prices is not increasing at the same rate. You can avoid this price effect. Only you can check the constant change, constant volume change only. Therefore, what do you think? Better indicator is not the current producer value, current price approach, constant price approach is better. That's why we have two methods. value at current prices of the products, GDP or GNP at current prices, known as nominal GDP or GNP, another name, nominal. The nominal GDP, current production, current price. Next year, production, that price, current price, like that. Value at prices that prevailed in the past, selected time period, 100. This year production, base year price. This year production, next year production, base year price. Following year production, base year price. No price effect. Then this changes in this producer value reflect the changes in the quantities. That is more realistic approach. Now the current estimate, constant estimates are more realistic, more reasonable. You can change a real change in the coconut production, whether it has increased or decreased. If we use the current estimate, it might increase us. All the time it is increasing. That's the thing, that's the problem. I'll go to the board and just check these numbers. So this point is very important. For example, coconut example, let's say 2018. Coconut. Number of nuts is 1,500. What has happened? Coconut production has dropped 100 to 1,000 to 500. Price, let's assume price. Let's say 100 rupees per nut. Per nut. Then the let's say this is the 150 rupees per nut. Drop in the production, increase in price. Producer value is how much? Producer value 1,000 into 100 into 100. 100,000. Producer value 500 into 150. 150. I will change these numbers to 200. 200. 250. 500 and 250. It's an example. 125,000. 125,000. Coconut production dropped. Price increased 100 to 250. Producer value 100,000. Yeah. Producer value 125,000. 125,000. 125,000. This is 125,000. Now, see what happened. If you calculate GDP using the current prices, GDP has increased. If the, let's say, assume material input zero. So what is GDP? GDP equals this minus that 100,000. This minus that 125,000. That's interesting. What will happen? This is GDP. Because we assume in this economy only economic activity is coconut production, coconut cultivation. Right? Now what will happen? One can say, look, GDP has increased from 100 to 125,000. What do you think? Do you agree? No. One can say, look, but the production has dropped 1,000 to 100, 500 nuts. Then how do you capture that? To capture that, we value the production at constant prices. That means 100 into this one, the 1000 into 100, that is say GDP. This is called current. GDP constant means constant. Constant means you value the production 100, that is same as 100,000. Here also, we don't use 250. You multiply 500 by 1000. 100. That means 500. Now you can see 500 into 100. 500 into 100. 500 into 100 is this. Now you can see 100,000 to 550,000. 100,000 to 50,000 drop. Yes, increase. Now that's the difference between now what has happened here in this case. Why it has increased? Production dropped, price increase. But here what will happen? Why has dropped? Production dropped, price same. Therefore, no price effect. So then we can understand the meaning of GDP at current and GDP and constant. Now these two tables, first estimate is gross national product industry current market prices. Table 1, current market prices. GDP, all the 48 sectors, they calculate value added using current prices. Table 2. Table 2, they calculate prices, GDP, gross national product income industry origin by constant 2010 prices. 2010 is called the base year price, like 100. 2018, 100. Base year price. You use base year prices to calculate the GDP. That is more realistic. Table 2 numbers are more realistic. You can see the real difference. But here, first table, you have the both price change and the quantity change. Table 2, you have only the quantity change. Price change is fixed. 2010 prices are used. Now you can understand the difference between table 1 and 2 estimates given in the table 1 and 2. 1 and 2. Right? Okay. Right. So GDP or GNP at constant, GADP or GNP at current. Right. Then another methods to calculate this again the annual report 16, but annual report 19 also table 1 and 2 no difference. You can use AR19, table 1 and 2 same. Table 1 and 2 same. 48 sectors, current prices. Table 2, 48 sectors, constant prices. Now these are some of the concepts. Gross value added at basic price. GDP at market price. GNP at market price. GVA at market basic price. GDP at market price. GNP at market price. In this case, we call it current market price, constant market price. GDP, GNP. In addition to that, you have this GVA, gross value addition. But these are the concepts. Initially, you calculate gross value addition. After that, make some adjustments, GDP. After that, make some adjustment, GNP. Right? Conceptually, it is there. Calculation, adjustments are there. For example, I can tell you table 1, appendix table 1, AR19. I have the latest one, AR19. GVA basic prices. You taxes less subsidies on products. Get GDP. GDP and net primary income from rest of the world. I showed you the BOP. Get the GNP. Table 2 also same adjustments are there. GVA at 2000. The GVA at basic prices. Taxes less subsidies on products. Then you get gross domestic product at market prices. After that, again, net primary income from rest of the world, gross national income at market price. concepts, right? So these actually the now in this find it, the definitional differences are not, you are not supposed to know these definitional differences, but you have to know current estimates and constant estimates. Why they are useful, which is more meaningful. Constant estimates are more in table 2, numbers are more meaningful. Current estimates also we use to calculate per capita, but in calculating growth rates, we use table 2 numbers. Calculating the per capita income, we use table 1 numbers. In calculating deflator, we use both the table 1 and table 2 numbers. Understand? Calculate the growth rate, GDP growth rate, we use table numbers in the table 2. Calculate the per capita income, we use the numbers in table 1. To calculate the inflation rate, GDP deflator, we use numbers given in table 1 and table 2, both combinations, combined. Remember, we don't expect you to remember the by heart the definitional differences of GV and GDP or GV and GNP. But GDP, current and constant estimates, you are supposed to know. I gave this example, right? That's why I'm avoiding these. These are the, I have given these definitional differences, basic price, GDP at market price, GV at market price, GNP, but these definitions are not that important, right? Now the calculation, difference between real and nominal estimates. Now the calculations, I have given some numbers, right? Up to 2016, I want you to, as an exercise, I want you to get the 2019 numbers and just get these numbers and update this table. That's a homework exam. You have to take these numbers, you can see. I have given this, copied this from directly from the annual report, the table 1 and table 2. First set of numbers 2013 to 16, now copy down from annual report, appendix table 2. Second set of numbers, copy down from the annual report, appendix table 1. I have shown you the 1 and 2. You can see last the row, you have these numbers. You have these numbers, right? Okay, rupees billion, real GDP and GNP. Real GDP and table 1, real GDP, it is called, they use the term, yes, real GDP at gross national product, yes. Last 3 rows, table 1, last 3 rows, you can see they are bolded. I think I will show you those numbers. Yeah. Now you can see this table, table 1, last 3 rows. Last 2 rows, gross domestic product at market prices, gross national product at market prices. Table 1, that is real GDP, real. Table 2, again last 2 rows, bolded one, that is the gross domestic product at market prices, bolded one, black. Last row, GDP at market prices, bold one, constant prices. That's why I want you to go through this 2019 annual report and read the annual report and get these numbers and update these. GDP at market price, table 1, table 2, these are the numbers. 7846, 8235, that these are the rupees billion. GDP at market price, 9012, 2016. Then what does that mean? How do you interpret that? Rupees billion. First table, real GDP. Within brackets, you can take down constant GDP. Second one, nominal or current GDP and GNP. Current market price. Nominal or current. Real or constant. You can see the nominal GDP 9592, real GDP 7846. 2013, 2014, GDP at market price nominal below table below 10361. Same year, constant of the real GDP 8235. 2015, nominal GDP 10952. Same year, real GDP or constant GDP 8633. 2016, 11839. 2016, 9012. Real GDP is less than the nominal GDP. Why is that? Because the nominal GDP, in calculating nominal or the current GDP, we use prices and the quantity change. In calculating the real GDP, we use base year prices constant prices. Therefore, these estimates are lower than the nominal GDP. Real estimates are, real numbers are less than the nominal numbers. That is the first observation. Why is that? Same price is used. The nominal GDP use higher prices. Prices are higher. Price change is also there. Quantity change and the price change. Real and nominal estimate. That's why this national income accounting, there are large number of concepts, definitions. But at this level, we expect some definitions and the interpretations, but mainly the interpretations are important. Growth rate, calculating growth rate, calculating the per capita income. For example, we at 2019, our per capita income is the dollars, US dollars, 3,000 around 2,900, 3,900, let's say 4,000 per capita GDP. How do you calculate this number? Next step. Now I have given this difference. When GNP or GDP is compared between two periods, nominal GNP or GDP includes both nominal, you can take down current, right? Price change and quantity change. Real GNP and GDP, real mean constant. GNP and GDP includes only the quantity change. Why? Price is fixed, base year prices are. Therefore, the growth of real GDP or GNP is the economic growth. Economic growth means increasing real output, increasing real coconut production. Now, around 1,000 to 500 drop. There's a drop in coconut production. Drop in coconut production, right? Then the 50% drop. That is the economic growth. Change in real GDP or GNP is called the economic growth. Nominal GDP is not useful in calculating growth rate. Why is that? Because there we have the price change and the quantity change both. The real GDP, you want to check real growth, real change in coconut production, right? Okay. Key indicators. Now we know in the national income accounting, we said we have a large number of key variables, like to explain the health of the economy or health of a person. Last week we said we have a large number of indicators. Blood pressure is sugar level, cholesterol level, then the serum creatine level, cholesterol, the cholesterol also, triglyceride, good cholesterol, bad cholesterol, like that. Large number of indicators. Then using this movement of these indicators, doctor, your consultant, okay, sugar has increased, cholesterol has increased, so you are not doing well, you are not taking enough measures, so cut down your sugar, the base, the food, cut down the protein based food, like that he advise you. Like that, these are the indicators. Economic growth, one of the indicators. Per capita income, one of the indicators. GDP deflator. Savings ratio is very important. Investment ratio very important. Now in Sri Lankan case, our savings GDP ratio is much less than the investment, much less than the investment GDP. Why that? Our savings not enough to finance all the investment. There's a gap between savings and investment. Low savings rate is the key development issue. Investment rate is higher than savings. Why is that? Then domestic savings is not enough to maintain the investment level. Therefore, we need foreign savings, foreign aids, foreign transfers, foreign helps, foreign loans, FDIs. So then only we can maintain investment at a reasonably high level, right? Savings GDP ratio. Economic growth, how do you calculate? Economic growth rate, I have used 4 years statistics from the Central Bank Annual Report 16. Remember, I want you to update these numbers using the Central Bank 2019 numbers. You can get the numbers from table 2. Read these numbers and write down 17, 18, and 19 numbers. 17, 18, and 19 numbers, GNP and just compare these numbers, write down. GDP growth rate. How do you calculate GDP growth rate? From 15 to 16. 15 value GDP 8633. 16 9012. Rupees billion GDP 8633. GDP at market prices. Real. Table 2 values. Table 1 current. We need table 2 data. Percentage increase 8633 to 9012. Calculate 9012, 8633 to 9012. I'll give the numbers, calculator. 9012, 9012. Percentage divided by 8633. 8633 equals minus 1 into 100. 4.4. 4.4 is 8633 to 9012. Growth rate 4.4. 8235 to 8633. Growth rate 4.8. 7846 to 8235. Growth rate 5. Now you can see growth rate is falling. I can read what is happening to growth rate up to 16. We were maintaining fairly okay. Growth rate was fairly okay. 5%, 4.8, 4.4. Now I can treat this other years the growth rate. Other years growth rate I can see 16, 17, 4.2 GDP. 18, 4.4. Sorry. I'm sorry. GDP. Yes. 4.4, 16, 4.4, 17, 3.6 drop. 18, 3.3 drop. 19, 2.3 drop. Right? 20 estimated growth rate is marginally positive, 1% to 1.2%. Right? That's negative growth rate. What for the world economy? I think our negative is negative growth rate. You can see the growth rate, estimated growth rate. Yes, because of the COVID issue, no, it's a special year. Now you can see GDP growth rate is falling 5, 4.8, 4.4. After that, 4.3, 3.6, 3.2. Growth rates falling, right? The 4.4, the 4.4, the 3.6, 3.3, 2.3 on something. Economic growth rate is falling. Economy is not growing fast. Our economic growth rate is falling, right? I'll go to this table. Let's see what has happened to our growth rate, trends in growth rate. Now you see the growth rate up to 2013. Highest growth rate is 78, 8%, more than 8% growth rate. Again, just after the war 2010, again we had a very high growth rate. Now growth rate, what is happening, around 4%, then it is 2%. Now 2020, 2019 it was 2.3, very low growth rate. 2020 it is marginal negative growth rate, right? Economic growth rate is 8% now, a very high growth rate, 8% now. Why this is important? Negative growth rate also there during this the LTT period, right? We had negative growth rate, right? Then why this economic growth rate is important? Why it is important? Because any country, if you see US, UK now these days, economic growth rate is negative. Most of the developed countries, US minus the 20%, minus 30%, the minus 5%, minus, because of this COVID issue, right? 2020 growth rate was also negative, right? So the then why that? When economy is shrinking, economy actually is shrinking, unemployment is rising, tourism is falling, construction is falling, negative, right? So therefore, economic growth rate is, that's why very good indicator. So the 2020 is exceptional year because of this COVID, everything, economy is shrinking, right? So the no investment, no tourism, no construction, the reason, right? The in our case, the huge unemployment level, self-employed, were affected. Self-employed people around 40 to 45%, 50%, more than 50% is for self-employed, dropped, right? So these are the reason. Economic growth rates and employment are very closely related. When economy is growing very fast, very low unemployment rate. Why is that? When economy is growing, companies will have to employ more and more people. They expand the output. Less unemployment. When economy is shrinking, more unemployment. More people are unemployed. Now, for example, quantity surveys around 200, 150 or 200 batch of quantity surveys came from the Middle East countries to Sri Lanka. One plane load came to Sri Lanka. So they were working. They had a very good salaries there. Quantity surveys are very growing, emerging. This activity in a huge demand from our Sri Lankan quantity surveys. So now they are coming back. So pool of they are coming to the unemployed pool. Our economic activities, our construction activities are growing. Then what it's very difficult to find jobs for them, right? So they can't find jobs. They may have their own savings. They are living on their savings. But one day, they are a very capable person, highly qualified. Whether you can't go abroad if you don't have the very good experience, exposure, and the qualification, academic qualification. They are very well qualified people. Now, it's a bit difficult to find jobs here. Not only that, now on top of that, more quantity surveys are coming from our universities. Katubadda, the Peradeniya, and the other Labuduwa technical the universities. Full of them, unemployed people are there. So these are the reasons. Economic growth rate is a very good indicator of the employment level, economic activities, economic performance, right? So think about, I want you to think why that indicator is important. Always we are thinking about 4%, 8%, 9% minus growth rate. Why it is important? You must be able to explain. Right? US economy is shrinking, negative growth rate. European countries shrinking, huge unemployment. But the thing is, our unemployed stock and the US unemployed stock is different. Huge difference. Why is that? Our unemployed are not getting any benefit, unemployment benefit from the government. We don't have enough resources, reserves to get there, enough money. We are the developing country, poor country. But you see, US now recent this Biden government get the approval from Senate about 1.9 trillion US dollar rescue package. Approval from. Most of this money goes to the households. 1,400. If you are earning less than $75,000 per annum, you are getting a check of $1,400 monthly check, just to maintain your living standard, purchasing power. But here it is different, right? We are poor. Unemployed are not getting that much of money, right? Australia have the rescue package. US has the rescue package. Germany has a rescue package. France, Italy, they have rescue packages. Just giving money to the people. But here we can't do that. They are developed country. Their reserves, huge reserve base is there. Right? You can use those money. Right? Not only that, another objective is to encourage consumption. Now the Australia give money to the people because with this money you enjoy. You go trips. You go to the pub. You enjoy. You go to the beaches and more economic activities. They want to encourage consumption. Then economic growth will be high. Okay. Now this table is important. I want you to understand the link between growth rate and the unemployment level. Why this indicator is important. How to calculate this growth rate, right? And exercise. Please take the 2019 annual report and update these numbers and calculate GDP growth rate. You can compare these numbers and maybe past numbers may be slightly different. For example, 9012, it might be 9015, 8633. It might be because when you update the numbers, revise the numbers, small revisions will be there. But more or less the same trend is there. Calculate, copy down the GDP and GNP for other years up to 2019. Calculate the GDP growth rate and see what will happen. It is growing. Growth rate is growing, falling. Now, another important indicator: per capita income. Per capita income, per person income, per capita income. It said it's also another important indicator, right? Actually, some disalignment is there. The 2013 year, 14, 15, 16 years. Now for this one, we use information given in table 1. Earlier one, we use information given in table 2. What is the difference? Table 2 has the constant estimates using the base year price. Table 1, you have the current estimate, current price and current output, current price and current output. Right. To calculate the per capita income in dollars, we use table 1, information given in table 1, last 2 rows. I have copied down 9592 10361 because the earlier table also you have this. Sorry. Yeah. 9592, these are the table 1 information. Same information is there. 10361. GDP at market price, table 1. GNP at market price. Next row, you have the mid-year population. Thousands. 2585, 2771, 2966, 21203, 2016. Our total population was 21.2 million. 2015, 20.9 million. Average exchange rate, rupees per dollar, 129, 130, 135, 6,000 is 145. Now it is 196, 97, like that. Exchange rate, you can go to the Google. excuse me, exchange rates, I can check that exchange rate, yes. Indicative exchange rate, indicative buying and selling, indicative exchange rate, I can tell you, is 13, latest. US dollar. Yesterday I checked that exchange rates. Yes, wait a minute. Yes, 199 exchange rate. The 199 around 199. Euro 240. Great Britain 280. Right. Pound 280. 199. Now years 2016 it was 145. 60. 2000 today actually 2000. This is 2000. This is today is March the 13. No. March 12, March 11th, 199 selling rate, right? 199. It's a huge depreciation. Then how to calculate per capita income in dollars? How do you calculate? I will go to the board and calculate these GDP numbers, right? GDP numbers, right? Go to the board. First, I take down the numbers. I write down first numbers 2016. GDP at market. GDP, let's say GDP 11,839 rupees billion. Rupees billion. GDNP, GNP 11,506. Then we have the media population. 21,206. Thousands. Then we have the exchange rate. Yeah, 145.60. Then let's calculate GDP per capita. Per person. How do you calculate? You take, this is rupees billion, 11,839. How many millions? Put another 30. Million GDP. Divided by population. This is thousands. Then you divide that by millions. If this is million, that's also million. 21.203 million population. Then again, this is a rupee value. Divide that by the exchange rate to get the 145.60. Understand? This is in million. 11,839 billion. Put 3 zeros to get million. This is million. Then 21,203 thousands. Then million 21.203. Population. Per person divided by the population, media population. Into exchange rate 145.60. If you simplify that, you can get, we should get theoretical 3835. Please do the calculation. 11,839,000 divided by 21.203 equals divided by 145.60. 145.60. 3835. Dollars. per person, $3,835 per person. Understand? GDP. GNP, same calculation. GNP per capita. 11,506. Billion, make it million. Divided by the population. Thousands, million. 21.203. Divided by the exchange rate. That is GNP in the dollars per capita per person. 11,506. 11,506,000 divided by media population millions 21.203. Can you see the board? Of course. Can you see the board? Hello?
Yes, sir.
203 equals divided by 145.6. 3727. 3727. Yes, 3727. 3727. Per person. Right? That's how we can. Another indicator. Earlier we calculated GDP growth rate using table 2 numbers. Then per capita income we calculate using table 1 numbers given in table 1. So I want to again please copy down 2017 to 19 GDP and GNP market price. Media population. Media population numbers are in the annual report. The key economic indicator, very first table. I'll show you. Key economic indicators. Yeah, you can see this one. This table first. You can see the first row is about the population. You can see the population. You can get the media population numbers. 21,203, 21,444, 21,670, 21,803. Media population. Exchange rate, same table. These are the very beginning of the annual report. First table, key economic indicators. All the key economic indicators are there. Exchange rate, it is the US dollar exchange rate. 45.60, 145.60, 2006, slightly changed. 149, 145.60 US dollar exchange rate. Then 152.46. This table. Right. These are the tables. Actually, I will show you the numbers. Yeah, these are the tables. This table, media population here. These are first table, first few tables. Exchange rate, first table in the annual report. All the key economic indicators about the economy is given. First row is the media population. Media population. Then the exchange rate numbers are in this next page. Next page you have the exchange rate, US dollar exchange rate. It is there. Get these numbers and update that table. Right. Update this table and calculate per capita income. Per capita income. Per person income. Then you can say why per capita income is important. US dollar. US economy 44,000 US dollar. So 44,000. 29,000. Right. As I can remember, 45,000. Then Europe, Germany, it is 37,000. Japan, 29,000. Ours, 3,000. Around nearly 4,000. Not 4,000. Right. So you can rank countries according to the per capita income. That ranking is the ranking of the development. Most developed country, US, Japan, Germany, Kuwait. These are the highly developed countries. This ranking is about in terms of other socio-economic indicators. Japan, literacy rate is 100%. Sri Lanka, literacy rate is around 95%. Then life expectancy, Japan, right? nearly the life expectancy nearly 95. Ours, male and female, 91, 92. Ours also, Sri Lanka is called outlier. Outlier. What is outlier? Sri Lankan performance are called outlier. Economists explain our behavior as outliers. Why it is outlier? Because if you have the per capita income with this nearly 4,000, our indicators are much better, comparable with some of the developed countries. Right? If you put all the countries around 4,000 US dollar into one basket, Sri Lanka and other countries, the Maldives and not Maldives, Malaysia, the other regional countries, 4,000 basket. If you check other socio-economic indicator, literacy rate, infant mortality rate, life expectancy, computer literacy, our indicators are much higher. They are comparable with other developed countries. That's why it is called Sri Lanka is an outlier. We are going above the trend, right? Outlier. Then economists do research and they have found because of we are maintaining closed economy, subsidized economy, subsidy economy for a long time, welfare economy for a long time. So our health indicators are good, educational indicators are good. So other socio-economy, infant mortality rate, literacy rate, life expectancy, they are really good, right? Because of this, there are various research are going on. This is one of the reasons. So maintaining the welfare state for a long time. Right? Still, we are pumping money to the health sector. Huge budget, government hospitals, huge government budget. We have private sector hospitals, but majority of the Sri Lankan people going to the government hospitals, right? They can't afford these expenses in the other private sector hospitals, right? So that means government budget, from the government budget, huge allocation is going to the health hospital sector. Then education, government hospitals, government schools, right? Like that, people are enjoying those facilities. Therefore, their literacy rate, the other health indicators are good, right? The outlier. So that is different reasons, but ranking of in terms of per capita income is a ranking of development. That it is a ranking of in terms of other economic indicators as well, right? So what are the other economic indicators? Literacy, life expectancy, infant mortality, computer literacy. Computer literacy is another new indicators are there. Computer literacy, right? Then what else? What are the other indicators? Other indicators, other nutritional level of the people, right? Then the poverty, another economic indicator, poverty level. Yeah, on aggregate level, we have but the percentage wise, our poverty level is very low, right? Unemployment rate, another indicator, around 4%, right? Actually, think about now this 20 and 21 is out. Again, they are outliers. This you can't use those, but compare those with the trend. Trend is our unemployment rate is around 4%. Whereas this 2020 it has increased, 2021 it has increased. We know the reasons, right? Because of this external shock. But when we were maintaining 4% unemployment rate, Spain unemployment rate was 25%. Greece unemployment rate one time is very high. In our case, only 4% in the labor force are without jobs. Now I'm talking about 2016-15 period, right? Only 4 persons in the labor force are without job. Spain, 25 people in the labor force, 100 in the labor force without jobs. In Sri Lanka, 4 persons of 100 labor force, 100 in the labor force without jobs. Much better. So these are the unemployment rate is very high. We had unemployment rate is huge unemployment rate in 1970 to 77 period. You can talk to your parents. So that time unemployment rate is very high. right? Around 20%, 22%. People without jobs, right? Of the labor force without jobs. Unemployment is improving. 2021 is because of the external shock, COVID shock, unemployment rate increase, right? Where the tourism sector shrink, construction sector shrank. Then the Middle East people came to Sri Lanka. So our qualified doctors, qualified engineers, qualified quantity surveyors come to Sri Lanka, qualified computer personnel come to Sri Lanka. They are in the unemployed pool. That is the reason, right? Okay. Please, this calculation, please understand how to calculate and understand the interpretation, why it is important, right? You want the earlier table, how to calculate GDP growth rate, why it is important, how to get the real numbers from the central bank annual report. That's also important. That is part of this the exercise. Yes, then GDP deflator. Now to calculate GDP deflator, we use data in both tables, table 1 and table 2. To calculate growth rate, we use numbers given in table 2. To calculate per capita income, we use numbers given in table 1. And of course, exchange rate, population. To calculate GDP deflator, we use numbers given in both table 1 and table 2. Table 1 and table 2. Table 1 and table 2. Sorry, excuse me. What is deflator? Deflator 1.2225, 1.2581, 1.2684. These are we have calculated deflator for 4 years. Percentage increase in deflator 1.2225 to 1.2581. Percentage change is 2.9. Then 14 to 15 percentage change 0.8. 15 to 16 percentage change 3 points. I have bolded this one, black. This percentage increase in deflator is called inflation rate. Is also a measurement of the inflation rate. Generally, inflation rate is measured using Colombo Consumer Price Index or New Consumer Price Index calculated by the Census and Statistics Department. Monthly, every month they publish, every year, every month they publish the index. Percentage increase in index is the inflation rate. Official CCPI, NCPI. But this is called deflator also can be used as a proxy, as a measurement of the inflation. First to calculate deflator value, percentage increases are the growth rate is the measurement of inflation. How do you calculate deflator? This value 1.22, 1.25, 1.26. How do you calculate? That is table 1 and table 2. First row coming from table 1, 9592, 1361, 10952, 11839. Table 1, last row. Row before the last one. GNP market price. GNP market price coming from table 2. AR16 table 2. 7846, 8235, 86. Now, ratio of this GDP and GNP is the deflator. At market price, current prices 11839 divided by 9012 is 13137 ratio. Then 10952 divided by 8634 is 1.2684. Ratio of GDP at current prices. Or both are actually both should be GNP, right? Not GDP. I have done some mistake. Not GDP and GNP. I'm sorry. Table 1, GDP. There's some revisions are there. 13, 16 number is 11996. 11996. The 10952 is okay. 15 number, that is GDP at market price. GDP at market price. Then the other table, GDP at market price, yes, that's also GDP 9, 8012, 8012, 8012 has become 8035. Actually, please, GNP also, please change that to GDP. In this, that is all a GDP. I've done some mistake. Cut this N and then put the GDP. Both GDP at market prices, current, GDP at market prices, constant. Not GNP, remember, please change that. Then GDP, both should be GDP. GDP deflator is ratio. Then percentage increase in GDP is called the GDP deflator. It's the inflation. Now in this annual report, they publish. Annual report, they publish indicators. Indicators, you can see the first base key economic indicators. You can see the table. GDP deflator. Yes, it is the prices and wages. GDP deflator. Yes, they are in here. This area. This area you have GDP deflator. GDP deflator. 6.2, 2.9, 0.6, 4.9, 7.3, like that. GDP deflator. You can see that. Right? Along with the other CCPI numbers, CCPI, all the price indices, CCPI, then the new consumer price index, all are given in this area. Percentage increase, inflation. Right. Now this, I think we calculated what? This growth rate using the table 2, then GDP per capita using table 1, then deflator and the inflation the rate using table 1 and table 2. Now this, we go to the next slide. Expenditure approach. Anyway, we can give that. In the expenditure approach, we have GDP expenditure is all the expenditure. Consumption expenditure, how many rupees billion. Investment expenditure, investment done by the firms, businesses. Government consumption and investment, government. Exports, value of exports, minus import, because imports coming from outside. No? Therefore, gross, within the gross domestic product, when you calculate gross domestic product, you deduct imports. Imports going out. Deduct that. C plus, I plus, G plus, X minus M is called GDPE, gross domestic product expenditure. Here you see now. 3 ways of measuring national income. First, GDP value-added approach is we calculate, and GDP expenditure by whole economic agent, C plus, I plus, G plus, X minus M. Right. That is the one. So the gross domestic product expenditure can come about if consumption expenditure increases, GDP increases. If investment increases, GDP increases. If government expenditure increases, GDP increases. Then the net exports, we call it X minus M, net export increases, GDP increases. In other words, if you want to increase GDP, increase consumption. Let people to consume more. like in Australia, they give money, transfers, check of 600, 700, 8,000 rupees. In US, they give money to the people, $1,400 check. Why? To increase the consumption. Again, this rescue package of trillion rescue package US recently approved by the Senate. There's a part going to the small scale companies to prevent bankruptcies, to maintain their activities. They give investment activities. They give part of the money going to the company sector, business sector as well. Investment increases. Government of course increase expenditure. GDP increases. Net export increase. If you can increase exports, reduce imports, you can increase GDP. Because of this COVID problem, we did that. Government did that. We want to increase X minus M. How did we do that? We put restriction on non-national essential imports. Imports decreases. Exports, of course, we want to increase exports. Export sector is not performing well. But at the same time, same level of export, import decreases. X minus M increases. GDP increases. So now if someone asks how to increase GDP, you can say increase consumption, increase investment, increase government expenditure, increase X minus M. Then policies to increase consumption. How do you increase consumption? Increase consumption. What will happen? What will happen? If interest rate falls, if interest rate increases, what will happen? People save more. If interest rate decreases, people consume more. If taxes decreases, what will happen? Your disposable income increases. Government cut taxes. Disposable income increases, consumption increases. So therefore, either you can use tax policy or interest rate policy to increase consumption, increase GDP. When government cut taxes, we can increase disposable income increases, consumption increases. I'm sorry. Then investment. Investment and interest rates are closely related. When the cost of funds decreases, investment increases. Cost of funds decreases, investment increases. Government did that. Because of the COVID problem, now government gives various interest or the debt moratorium to the small scale industries, investors. Low interest rate loans, increase investment. Of course, government increase their expenditure. Remember this the first COVID wave or first wave of COVID, the government gave poor people 5,000 rupees. 1 or 2 months after that they stopped. We didn't have money. Like other developed countries, every month you are getting the check. So when government increase the expenditure, budget deficit increases, then actually G increases, GDP increases. Change in X minus M, I discussed. Either you find new markets and increase exports, or you reduce imports. Because of this sudden shock, COVID, we try to reduce imports. Import restriction. Non-essential imports are restricted or fixed, constant, they reduce. X minus M increase. So this is a good identity just to understand the factors, policies to increase GDP, right? Through the expenditure side, consumption, investment, government expenditure, and these ones, right? Now, developed countries use this identity to increase their expenditure, right? Now, we come back to this circular diagram. First diagram, closed economy without government. Now I said Y equals C plus S. People are getting income, consume, save. Business sector, GDP equals C plus I. At equilibrium, GDP, value of GDP is equal to value of the income, Y. C plus S equals C plus I. C cancel out, S equals I. This is a very important relationship between savings and investment. What is that? Closed economy. In the closed economy without government, investment equal savings. What does that mean? Investors, business sector, investment exactly equal to the private savings, household saving. We are only who save? How many savers? Only households. How do we finance investment? Investment is financed using savings. I equals S. Now we write down identity. Y equals C plus S plus T, households. Consume, their income is consumed, partly consumed, part is consumed, partly they pay taxes to the government, balance save. GDP, C plus I plus G. Business sector, supply, is a demand. Then at equilibrium, C plus I plus G equals C plus S plus T. Now you can say very interesting thing. Investment in the closed economy with government is equal to savings, private savings, S, plus T minus G. What is T minus G? T is government tax revenue, G is government expenditure. T minus G is the government savings. So, to finance the investment in this economy, you have two parties, two players, household savings plus government savings, T minus G. Sum of these two is equal to investment. If household saves more, you have more money to invest. If government save more, T minus G increases, more money to invest. Full economy. Y equals C plus S plus T plus M. GNP equals C plus I plus G plus X. At equilibrium, what will happen? C plus I plus G plus X equal C plus S plus T plus M. I equals, where the C cancel out, you take G to the right hand side, X to the right hand side. Keep I only. I'm tired now. Then investment equals savings, private household savings, plus T minus G, government savings, M minus X, foreign savings. Three players, three types of savings. Investment in this open economy can be financed either using household savings, government savings, or the foreign savings, M minus X. Sum of these three savings component is equal to investment, right? If government saves more, you have more money to invest. If foreign savings more, you have more money to invest. If household saves more, you have more money to invest. Understand these identities. Now that's the end of this lesson. Please do the homework assignments. Take the 2020. If you can't find the hard copy, go to Central Bank web. Central Bank web. Central Bank just type the Central Bank of Sri Lanka. They give this website. Take the Central Bank annual report. It is there. All the tables, appendix tables are there. Work out these examples, right? Complete these tables. Next week, we will start mathematical approach to calculate GDP, right? Okay, equation. Okay, thank you. Thank you very much. We'll stop now. Thank you.